Okay, so I have to go to the doctor this week, tomorrow, and I tried to change it. It's an annual physical, but I can't get out of it because it's so difficult to get these appointments. So just please bear with me. And I want to, but I did not want to skip the class at class time. So I'm creating this recording for you to go over the homework, all right? And this way we could at least cover this. I feel if I go over the homework with you today, then my next thing would be on next Thursday, right? Next Thursday is the next time we meet. Then we can go over the homework again, and I can start working on the work that I gave you in Chapter 3, which you could start working on because it's just a follow-through of the work that we have been doing. So at any rate, let's go over these problems together. And you could use them if you haven't finished your homework or you want to just to get a little bit more illumination on it. So basically, you see the Chapter 3 assignment. You could start working on that. And again, I'm trying to give you a break on assignments. So what I'm trying to do is create a situation where I'm trying to create a situation where you can work ahead a little bit and not be penalized for not learning everything. But I noticed from the first assignment, you guys did great. So it's enforcing to me that you're doing the reading. Now, as we move along, obviously, there's going to be stuff I'm going to teach, and then you're going to have an assignment that you have to meet certain standards, like when we get into hedging and that sort of thing. But here, so far, I think you guys are making great progress, so I'm pleased with the way it's going. All right, so let's talk about these problems, all right? I'm just leaving that up there because I don't like to play with this too much. Basically, when I create these recordings, I do it off of the Microsoft Gaming. Not that I'm a gamer, but that's the best way to do it. So I don't want to play too much with this system. But if you open up chapters 1 and 2 homework, let's talk about this. So in problem 1.1, we talk about a long forward position, which means you agreed today to buy the underlying asset on a forward maturity date at an agreed price. Your payoff maturity is you benefit if the price ends up above the price. In a short forward, you're selling the forward price. So for instance, like right now, I think the dollar is $1.18. Maybe you're selling it at $1.20 in a month. Now, if the euro goes down, it's a good position. Euro goes down to say 110 because the dollar strengthens. You've done a good job. You've sold or you've shorted. By short, I mean that you've sold it and taken a downward position on the euro, and so therefore, you would gain if it goes down. So what a forward basically does is it allows you to lock in a price at a certain price. As you're reading through Hull, you'll realize that a lot of the basic pricing is based on interest rates, right? The interest rate differentials. And we'll get into that a little bit more as we move along when next week comes. But there's always going to be an interest rate differential. So when they're pricing these forwards, what they're looking at as a base is the difference between what you can earn in one currency versus what you can earn in another. And then you got to also, even though that's the straight math, you also have to consider inflation adjustments. But that's going to determine the difference between both. But the difference also is those currencies can move up and down in lockstep. In other words, they can both move up, they can both move down. But the relationship between these currencies will be first based, without supply and demand, on interest rate differential. Okay, so a forward is basically either you're buying or you're selling a commodity, in this case a currency, either long or short, and you benefit by that position. Think about it just like buying a stock or selling a stock, but you're selling it in the future. Okay. Problem 1.2. Hedging uses derivatives to reduce risk. Whenever I hedge, what I'm doing is basically so for instance, if I know I'm going to get a $1 million pound sterling payment in a month or in a year as a company, I can go ahead and go out a year or enter into a forward contract or futures contract, which I have to roll over. We'll learn more about that. Or I could use options. But what I'm basically saying is, if let's say I can lock in that euro at $1.18, this is the pound. Let's say I can lock in the pound at $1.35 in a year. Well, what's going to happen is, at that point, if I could say that getting the €1,000,000 at $1.35, given my expense structure, makes a fair profit for my investors, I'm going to try to do it because I want to take that variable out. I don't want my investors to say, hey, I hired you to run a business. I didn't hire you to play currencies. In most cases, you're going to hear that. And if they want to hedge it off, sometimes big institutional investors can do that. They may say, we want to hedge it off. We know what our limitations are. We'll go out like a Fidelity. But in this case, if I sell it, I'm locked in. So if it would have been better for me to wait, I give that up. If all of a sudden the pound goes my way and I could be making even more money, well, obviously I lose that ability. But on the way down, I'm protected. So basically what hedging is doing is just protecting your position. But it's cutting it off. That's it. You've defined your risk. Whereas speculation is just commodity traders or hedge funds going into the market based on fundamental data, based on prognostications, the same way people just buy stocks or even bet on the Super Bowl. And, that may be a bad, but it's not such a bad example. And with speculation, they're able to buy or sell these commodities to make a bet. Now, is it a good thing? Well, the long story short is yes, it's a good thing because it creates liquidity. It makes the markets more liquid. So the argument has always been academically, speculators are needed in the market. And finally, arbitrage is we're trying to exploit the difference between two securities that are like each other, but not exactly like each other. So going back to what I did for many years, convertible arbitrage, a convertible bond is part bond and part option. If I can sell the stock at a certain price and get the option at a cheaper price, I've effectively created an arbitrage. And we're going to, again, that's a subject as we come to the end of this class, I'm going to teach you about arbitrage because I think that's something I can bring to the table. But that's what arbitrage is. Now in problem 1.3, a long forward obligates you to buy the stock at maturity or the currency at maturity. You get the full linear exposure. The downside risk is real. It's $40. If it's $40, your payoff per unit is a long call with a strike of 50, gives you the right and the obligation to buy at 50. Your key differences are, calls have limited downside. We've talked about this. And the forward has no premium, but has unlimited downside. So think about it. The call participates in the upside with limited downside, but a time limit. We talked about this. But a forward participates each way, gives you real risk either way. Now obviously, you can't lose anything. If you're long a stock or you're long an asset, always remember this, you can't lose below zero. Nothing can go below zero. There's no negative value. But you can, on the other way, stocks can go to, or assets can go to infinity. In problem 1.4, writing a call means you own the stock. And you're writing the call as a premium. So I own IBM at 100, and the 110 calls are trading for a year at 5 points. Maybe what I do is I sell, and this is a very popular strategy, which I'm going to suggest as we get there. Maybe what I do is I write that 110 call for $5, take the $5 of premium in. My worst case scenario is the stock goes to 110, I get called away, I've effectively made 15 points on $100. And I brought $5 of extra income into my account. Now, if the stock goes to 200, obviously I'm not going to be too thrilled about that because, I could have made a lot more money. But by writing premium in low volatility situations, I can bring in more and more income and protect my downside. So definitely that's what writing a call is. As opposed to buying a put where I'm paying the premium, but I'm protecting my downside and limiting my downside. So the same situation. Now, in a covered call, if I have the stock at 100 and I bought the 110s for 5, I'm basically protected down to 95 because I bring that premium in if the stock goes down. But with a put, let's say I buy a 90 put for $5, below 85, I'm protected down to 0. But I'm paying a premium. The other way, I'm bringing in premium. And there's more sophisticated strategies that we'll talk about. But if you can answer that and you understand it, that's going to help you when we get back to strategies. In problem 1.5, the question is, if you short a forward to sell 100 pounds sterling at 1.5, the short forward payoff at maturity is either a gain of 1,000 or a loss of 2,000, depending on how it trades. So if you just take 100,000 multiplied by the price of the dollar pound sterling and just equal it. Now, if you're short, you're going to lose money on the way up. If you're long, if you're short, you're going to make money when it goes down. If you're long, you make money on the way up. If you're long, you lose money on the way down. So remember that. The math is simple. The math is basically taking the price that it ends up at versus the price you got in the forward at, subtracting it and multiplying by the amount of your position. That's simple. That's trading 101. But remember, when you have a short position, you lose money on the way up. You make money on the way down because you've sold something you don't own. The opposite, the long position, is the opposite. You make money on the way up, you lose money on the way down. It's very simple. It shouldn't be difficult for you at this point. In problem 2.1, trading volume is the number of contracts that trade during a specific period, often a day, and it resets every day. And it's interesting to a trader because you want to know where the liquidity is. Commodities that have low liquidity mean they're not going to be priced efficiently. And if they're not priced efficiently, you're going to either overpay or underpay to get in that. Open interest is the amount of contracts that are out there. So you basically would like to trade commodities that have a lot of open interest and a lot of trading volume. This way you have more and more players and you're going to get a better price for this. Again, let's get back to the Super Bowl. If you're just playing, if you're a gambler, and gambling's a horrible idea, and you're playing like them, and for those of you who don't follow football, please forgive me, but let's say you're playing something like Minnesota versus New Orleans on a 8th week that nobody's really following the game, and it's like one of these games that are inconsequential, then the spreads are going to be kind of funny because not that many gamblers are in there and you're not really sure what the spread is. But when you play the Super Bowl where the whole world is watching, that spread is pretty indicative of where all this money is. Or it's just like the efficient market theory. When I have enough players in a stock, that makes the markets more efficient. In problem 2.2, a local is often a floor trader that trades on the exchange for their own account. So it's like a specialist. They use their own money and trade on the exchange for their own account to try to make money because they're standing there right in the pits. A futures commission merchant is a firm that solicits, accepts customer orders and futures, and accepts customer money. So basically, if you want to think about it, the commission merchant is like the broker-dealer, whereas the local is the person who makes markets. Now, years ago on the New York Stock Exchange, you had broker-dealers that handled client accounts, and then you had specialists that made markets in the stocks. This is the same thing. The local trades for its own account to keep the stocks liquid and make a profit for themselves, and they could lose money too if the thing goes against them. The futures commodity merchant is more like a broker-dealer or like the bookmaker. Think of it that way. Okay, problem 2.3. You were short July silver futures at 1720, and isn't this ironic? This was the problem, and today futures silver has gone crazy. It's in the 80s. You're short of July silver futures contract at 1720, and the contract size is 5,000. You have to put up 4,000. They won't. Because you remember you got 5,000 ounces at $17. So you multiply 5,000 ounces at $17. You're talking about a total position of 50,000 of 5,000 times 1720. So you're controlling in this futures, and that's why people trade futures. You're controlling, and that's what makes futures desirable for a lot of traders. You're controlling, but it's risky. I mean, you're controlling 5,000 ounces of silver at 1720. Eventually, it's $86,000 of assets. You only have to put up the initial margin of 4,000. Okay, that's what creates liquidity because people don't have to come up the whole 86,000 like they were buying or selling silver. However, the exchange is going to be very tight on your maintenance because they don't want to lose money. So you have to have at least 3,000 in your account. So a margin call will occur whenever you lose enough money that you're below 3,000. So in this particular case, if you take 5,000 ounce contract, because all contracts are like an homogenized amount. So if you take a homogenized account, right, and you take $3,000 and divide it by 5,000, it's 60-cent move. So if if the silver goes from 1720, do the algebra. If the silver goes to 1720 minus 60 cents, which would be 1660, and you multiply that by 5,000, you lost 3,000. Below that, they're going to ask you for more money, or they'll just sell you out. And they're not going to wait for you to get to 3,000. They're basically going to just sell you out. So you have to keep your maintenance in there. And the exchanges or the commodity merchant is going to be very tight. If you get anywhere close to where you're losing your maintenance, they're going to either say put the money up immediately, and they're going to want to see more money in that account anyway. Or they're going to just close out the position and you automatically lose the money. Okay? And that's problem 2.3. In problem 2.4, you long crude oil futures at 48.30. You close it out at 50.50. The price on December 31st is 49.10. So what are we saying here? You have an entry level, you have a closeout ledger, you also have a price at the end of the year. When futures are marked to market every day they're going to see what your profit or loss is, every single day. When you close it out on March 19, 2019, the position is fully settled via the mark-to-market process. Because you have a December 31st year end, you will have an unrealized gain based on this price, right? You're making money on December 31st. You're making a little money. You're making about 80 cents, 49.10 minus 48.30, right? You're making a little money on this. Then from 1/1 to the close, you make another 2,200. According to section 1256, typical for exchange-traded regulated futures, contracts held at year-end are marked to market for tax purposes, and net gains and losses are split 60% long-term, 40%. So basically, that's going to be a tax. That's going to be your tax implication. So at the end of the year, they're going to tell you got to put this on your taxes. And they're going to tell you it's going to be 60% long-term, 40% short-term. Even if you didn't sell, because with a stock it wouldn't have happened. But with futures, they do that based on section 1256. You mark to market at the end of the year. Now, if you're a hedger, if the position is a bona fide hedge that's properly identified, gains and losses are commonly treated to match the hedge exposure and are often ordinary rather than capital gains. Section 1256 has an exception framework for hedging. So if you're hedging, they're going to treat you a little different. But if you're a speculator and you just bought this thing to make money, you're taxed under Section 1256 on a mark-to-market basis. So speculators get taxed. Hedgers, if they can properly identify it, and your bank will identify it for them, your broker will identify them, you get treated different and you have an exception. So those are the that's how this works. I chose these questions because they're the most difficult, or they're probably the trickiest. And again, we're getting back to fundamentals like we did with options. Now we're getting the fundamentals in futures. And put your work in. You could use my guidance. I don't have a problem with that. I'm sorry I couldn't make it, but that's why I gave you this video. And on next Thursday, we're going to go over this again, and then we're going to go over the new stuff that you're responsible for. So have a good day, stay warm, and I'll see you next week. And if you have any questions, you know where to reach me.